Good morning, good afternoon, and good evening across all of the time zones around the world today. Thank you for joining us for our session, Measuring Risk and Returns Across ESG Investments. I'm Caitlin MacLean. I'm Senior Director of Innovative Finance at the Milken Institute, and we're very pleased today to have a fantastic panel of experts to talk about ESG. So please join me in welcoming, as I bring out virtually, our panelists, Edwin Anderson, who is partner in financial services at Oliver Wyman, Hiromichi Mizuno, who has a variety of affiliations, including a special advisor here at the Milken Institute, PRI board member and at Tesla. Deborah Orida, who is the Senior Managing Director and Global Head of Real Assets for CPP Investments. And finally, last but not least, Andrew Steele, Managing Director and Global Head of Sustainable Finance at Fitch. So welcome, everyone. Again, good morning, good afternoon, and good evening for all of the panelists in our various time zones. We're excited today because obviously throughout this current year and the pandemic and the various crises we've faced over 2020, I think there's been a focus on looking at risks that we perhaps were ignoring. And that could be social risks, that could be environmental risks, or a combination of all of the above. And as we see interest and momentum grow around using environmental, social, and governance factors in investment processes, now somewhere around 40 trillion in assets under management over the past year with some type of ESG lens, the question is not necessarily should we do this, but how should we do this? And not necessarily why is it important, but how are we actually going to do this and do this in a way that is data-driven and substantive. And we've seen that, if you're following the news, one day you'll see a piece coming out that says everyone is going to be moving towards an ESG strategy. And the next day you'll see another piece that says that it's a fad and it's going to go away. So I think, what we hope to do with this panel is really try to shine a light on some of the really important work that a lot of the folks in the financial services world have done within the evolution of utilizing ESG factors. So with that, we will get started. We would encourage everyone in the audience to, as you're hearing the panel, to type in questions. We'll take Q&A at the end of the session, but really hope to have a robust conversation. And if there are questions that you have about some of the practicality of trying to integrate ESG factors into your investment process, I encourage you to type those into the chat. So with that, I think, Edwin, if I could start with you, because, I think that there's a lot of confusion amongst investors when people talk about ESG versus sustainability versus impact versus the Sustainable Development Goals. You look at the Milken Institute Global Conference Program, and we have panels on all of that. And so I think that there's a knee-jerk reaction to say, I don't have a standard definition, so I'm confused and I don't know what to do. And you have laid out, I think, previously, a really good way to think about where we've had success in terms of using ESG as a risk assessment and mitigation tool, as well as maybe perhaps with slightly more limited success using environmental and social governance factors to try to look at positive impact. So can you talk a little bit about how you kind of see this space and how you lay it out so that it is perhaps slightly less confusing for some of the newer folks in the market?
I'm happy to do so. And I'd say that the points of confusion even hold through to longtime members, because one of the things that I'd say as a community we haven't done is settled on as clear of language as we might. So we can think about a spectrum between how ESG factors might affect the risk in my company to how my company affects ESG. And I think about that as risk integration versus impact investing. And the two can be quite different and sometimes even in opposition to each other, where the thing that would most, for example, protect certain social factors may involve you taking additional risk to those same sorts of social factors. So that distinction is key. And I think that covers through to some of your feelings about momentum you described before. I think ESG risk integration, being more thoughtful about ESG as a risk to the company, is an almost unstoppable juggernaut. It's being seen as the new fiduciary standard, and there's little question of what's happening there. As far as impact investing, it has remained in the grand world of the huge numbers we talk in finance, relatively small, but it has been growing very quickly. And I think it's the one that people sometimes question whether it will be a fad or not. And I think these different senses of momentum are important.
Exactly. Yeah, no, I think that that's really helpful. And I think so, Andrew, maybe over to you, because I think as Edwin just laid that out, certainly the risk component of utilizing these types of factors has been perhaps more well, kind of people have become more well versed in kind of talking about that and understanding why you use that. But even then, if you're looking at, for example, credit analysis, there's still some questions. So how are you guys at Fitch thinking about trying to provide some transparency for folks who would be looking at this and kind of interested in the services, but not really sure how they should think about it in terms of the types of ESG factors they should be looking at?
Yeah, thanks, Carolyn. I mean, there is, as Edwin says, you can talk a lot about it. You can use a lot of different terminology, but actually when it comes down to trying to work out the relevance and the materiality for making decisions, particularly in fixed income and credit, the devil really is in the detail. And we looked at this a couple of years ago. And maybe I also ought to wind back slightly and say that it's also important to remember that these are not suddenly new risks that have emerged from nowhere. These are risks that existed already, but the focus on them has changed quite dramatically, and the desire to be able to report on them as a separate category of risks and to really drill down into the details surrounding some of these risks has changed exponentially. And that's where the challenge comes when you try and integrate this into existing processes such as our credit ratings process. And we took the decision a couple of years ago that we would do this on a fully integrated basis. We don't believe this is a fad. We think that the future will involve detailed analysis around these components of risk on an increasing basis and right across the board. And so we took a decision to integrate right across all our asset classes and ratings. And we spent a lot of time working with our analysts to extract these risk categories from our existing criteria, so to identify the elements that are in the criteria that relate to these risks, and then extract them and display them separately so that we could then go about scoring them to say how much materiality they have to the ratings decisions that we're making. And it kind of sounds simple, but actually the process was very complex. It involved over 1,400 people within the company. It took around about 6 months, and we developed a framework with 100 different sector templates, but all of which concentrate on 5 thematic issues for environment, 5 thematic issues for social, and 4 or 5 for governance, dependent on whether you're a revenue generating entity or a tax supported entity. And the detail of understanding what relates to which general issue. So if you look, I mean, Edwin made the point that it's not just about an entity's impact on society, it can also be about society's impact on the entity. And so when you start to drill down into these elements of risks, it's really, really important to try and create something which is comparable, which is transparent, and which is standardized. And there's a lot of information out there, and at the moment standardization is lacking and is only really just starting to emerge. So what we tried to do for the credit component was to do that. So we now monitor and maintain over 140,000 environmental, social and governance scores on more than 10,000 entities. But even then, that's the credit component. And when you try and look beyond that and you look at broader issues, it still becomes quite complicated when you're trying to sort and categorize information that's available in the market. It's also very, very hard for companies and issuers to actually understand what they need to disclose. And that in itself presents problems, because if there isn't a standard by which they believe they should be organizing their information within their company, it's then very hard for them to implement internal controls and processes to produce that information. And it's almost impossible for somebody externally to try and audit the information and data they're producing.
Exactly, and I think that we want to get to the disclosure piece maybe in a bit. I do think that kind of the question becomes how do you design kind of the path of least resistance to make it easier for issuers and for companies to disclose the information that folks like Fitch would be looking for. Hiro, if I could go to you now, because you're obviously on the board of PRI as your former CIO of GPIF, obviously managing a significant pool of assets and trying to wade into this kind of ESG space. I would imagine you got some pushback, over a $1.7 trillion in assets under management, and really thinking about kind of wading through this kind of acronym soup of what to do, and how to kind of look at, especially allocating through managers, how they're both talking about ESG and their process, but what they're actually doing, right? To Andrew's point, there is a challenge in trying to kind of put some standards and transparency around these types of factors. So how did you, what were some of the challenges that you saw when you decided to start allocating with an ESG lens?
Sure, thank you. Well, first of all, I'd like to thank all the viewers of this Milken Global Conference. And I just recently became the special advisor to Milken, but I was the participant of the Milken Global Conference, and I benefit vastly from other other leaders' discussion. So I'm really glad that today we have people watching this discussion, and I've been. I was initially inspired by the talk at the Milken, and I decided to push the ESG agenda throughout my GPF tenure, which was about 5 years. So this is a kind of like trying to make my contribution to push this agenda forward, through the Milken platform. So. Caitlin, your question of the challenges I face and the pushback I had is probably I need like 2 or 3 hours to cover all of them. But 5 years ago when I first started, the reason why I decided to do something very unconventional as a chief investment officer to secure sustainability of the GPF portfolio, which was at that time $1.2 trillion, was a kind of like the consequence of my analysis of all the big and sizable asset owners' long-term performance. And one surprising discovery was whether they make more active investment, they take more investment in-house, or they do the private or real estate or infrastructure, whatever. But if you analyze the long-term performance of the big asset owners, their performance pretty much in line with the global economy or global capital market. So I just realized that just working within my portfolio, trying to create the portfolio works better than the rest of the world, the rest of the capital market. Probably not the best way to do that, and it's probably not good enough. So I decided to pursue sustainability to make sure the capital market and the society to support it will be sustainable. And then I kind of came across the ESG when I discussed the becoming a member of PRI, and I found that's the most efficient or effective tool for me to use in my dialogue with my team and also my external asset managers, rather than talking about the vague stuff. ESG people say it's still vague, but it's much better than just talking about long-termism or sustainability of the portfolio. So I pushed the ESG, but the first pushback was there's no academic, data to support ESG is the positive attribute of the portfolio return. And that I managed to get around, basically focusing on, because in our industry, when people talk about the positive return, that means better return than the industry average or like, the benchmark. So I actually changed it because the GPS portfolio managed mostly passive. So let's say we should find a way to make a passive portfolio, their quality better. And then, we started using ESG as a risk managing tools. But as some of the other panelists mentions, it's much easier to start that as the risk analytical tool. So I basically pushed the to avoid the discussion of the whether that's any statistics support for the positive attributes of the portfolio return. I said, it's obvious these are risks to the business and to our portfolio. Let's try to minimize it, right? So that's the first, actually, the step, and this is a huge step actually. And then we went to the discuss with all our external asset managers and money managers, and some of those the CEO of the big asset management company even called my effort as a religious effort. So 5 years ago, they're still not. Well, now that company says ESG is a core of their strategy, but that's actually the reality 5 years ago. And then afterwards, every time we push the boundary further, we always face the very common pushback, which is that there's no data, there's no statistics, there's no standardized information, and there's no proof of the performance. So I think this is a little bit chicken and egg. And although it's becoming more and more evident that the current market is showing the evidence of the ESG as a positive attribute, but I try to say it's meant to be a good opportunity for active managers before it's proven. And the one thing I definitely want to share is when you hear this word from the people who are not willing to get serious on ESG, which is it's a greenwashing, it's a ESG washing, and you need to know that there are two groups of people who use it as a reason not to go against the ESG. One group is people don't believe in the ESG. They use a lack of standardized data or the statistics as a reason why they don't want to do that. And the other people who are really serious about the ESG, and they are very frustrated. They cannot get the standardized information. So we just need to make sure that on one hand, we keep pushing how to get the more data from the corporate activities in terms of ESG, and then make sure that we can use it more intelligently. But at the same time, we shouldn't be disrupted by the people who just don't believe in ESG as the financially material information, uses a lack of standardized data as a reason why they don't do it. So, but just to wrap up my long answer, it's very difficult for me to just push it without the data. But I try to encourage the people. That's where the human the intelligence, a human asset management professional should kick in to pick up that challenge. So I think the people on this panel is all picked up that challenge in their own organization. And before I get too long, I just finished here, but I definitely want to, the response to the other question, how, asset owners should work on this agenda.
That's great. I do think, what's interesting about what you're saying is that, oftentimes what people will say is you're letting the perfect in the way of the good, right? So I think you're trying to have people say this has to be exactly right and this has to be just as we've seen it before, and sometimes don't allow for it to evolve as much of credit analysis as, it wasn't perfect to begin with as well, right? So I think the financial services world has continued to evolve, and this is just part of that. But you did mention some of the kind of more active investors, and certainly investors who have, kind of built that in-house. So not just relying on managers, but also building up that capacity internally. So Deborah, I think that actually leads really nicely to you, because obviously within CPPIB, what you've done is build a system through which you look at your investments across the board, across the portfolio, looking at kind of climate risk, certainly, but ESG broadly. So would love to hear how you all started to kind of build that up, and if there were a few kind of key areas that were proving more difficult to integrate into.
Absolutely. Thank you, Caitlin. So as you said, I'll speak from the direct investing side of our house, where we started integrating ESG into our fundamental or bottom-up direct investment analysis 10 years ago. When I joined CPP, we had a group that was focused on mostly incorporating ESG risks into our investment analysis and starting on the public companies side. But today, that group operates across our asset classes, including public equities, private equity, and infrastructure, for example. And the reason is that as long-term investors, we think incorporating ESG factors or considerations is just part of doing the proper analysis of the long-term risks and opportunities of an investment. And I think Edwin correctly pointed out that it initially started focusing on risks, environmental risks that might come to roost during the course of our holding period. But more recently, we've also seen opportunities, and we think about it from a financial point of view. So it's not the impact investing that Edwin talked about, because our mandate is to maximize returns without undue risk of loss. But even in that realm, the financial return realm, we're starting to see opportunities where ESG is creating interesting financial return opportunities. So for example, in the infrastructure space, opportunities to support the expansion of infrastructure that is required to meet the increased demand for renewables. But Caitlin, to go to your question about where has it been challenging, I think one of the areas through our journey that has been really challenging is the area of climate change. Because as you know, the science is uncertain, it's constantly evolving, but a couple of years ago, we decided to set up a separate firm-wide climate change program that is supported by our sustainable investing group, but involves people from across the organization. So we have our total fund management people thinking about how to incorporate climate change into our long-term portfolio design. We have people in our risk group thinking about how to measure the climate change risks in our existing portfolio through on a top-down basis through scenario analysis or measuring our carbon footprint across the portfolio. And then we have a group that's focused on thinking about how we incorporate climate change into our bottom-up fundamental analysis for our most material investments. And as you said, it's an evolution, and we started just requiring people to have a paragraph about the climate change potential risks and opportunities relevant to that investment in their investment memos. And we've now evolved to requiring bookend scenarios, the high transition risk and the high physical risk scenarios into their financial sensitivities in order to try to quantify the potential impact. Because it's very difficult to, with certainty, talk about the probability of each of those scenarios, but the scenarios there's more consensus, I would say, around the scenarios. And if we ask our investors to incorporate those scenarios, consistent scenarios, across our investments, we can at least line them up on a consistent basis.
Amazing. No, I think that's a great I think, kind of detail of the process. I'm curious just on that point, because Hiro mentioned, the kind of pushback that you get when you start this process. And so I would imagine that there might have been some pushback initially, just saying, please add a paragraph to now kind of bookend scenarios. And I just wonder if you could provide some comments about, how you've seen the quality of that disclosure, right? So have you seen that improve in terms of, I would imagine just initially getting them to do it was a win. But as we continue to move down this, kind of evolution to say that we would like, kind of a more robust analysis, have you seen that type of analysis grow in kind of substance?
I would say it's a work in process. The way that we try to really enforce the importance of this is by identifying climate change as an important pillar in our 2025 strategy and having executive sponsorship from the senior management team of the program. And then as we rolled it out, educating the investment committees about the climate change risks and opportunities and asking them to ask the teams as they come to committee about them. And that behavioral reinforcement was really powerful.
That's great. Maybe
I mean, I think I was going to chip in anyway, so there we go. I was going to say, I think education is a key word that Deborah used there, because certainly when we went through the integration process, we found that we probably spent more time on internal education, calibration, and consistency checking in terms of how people approach different risk aspects when they're trying to look at these individual areas as a single identified risk. And the number of prejudices that you unsurface when you're doing that is quite remarkable. So for instance, as we worked our way through different sectors, our airline analysts were desperate to bash the airlines for greenhouse gas emissions, but actually when it comes to credit analysis, at the current moment in time, there really is no credit consequence for airlines. And similarly, when you look at things like the natural resources sector, there's a tendency to say, well, natural resources can be heavily polluting and therefore it's very bad for the environment. But when you look at it from a pure credit perspective, what you discover is the majority of credit events that crystallize for natural resources companies are usually a result of failure of governance, where they failed to follow an operating policy or procedure that's led to an accident or a spill. So it's kind of really interesting as you work your way through the detail and you educate people on this, what you discover is that the patterns are not necessarily the obvious ones that you see people talking about in the media.
And can I ask then,
Kevin, I might even riff on.
Yeah, go ahead.
I was going to riff on Kevin's. One of the things I found is that when I look at those past patterns, I'd agree with you. But forward-looking, I think it's a little bit more complicated. So I may be a partner at a consulting firm now, but I've spent over a decade of my career as a credit analyst in debt and fixed income. And when you look forward, you may ask questions about, for example, transition risks around carbon taxes, where things are not being priced at any price reflective of impact, and there certainly haven't been credit events meaningfully drawn there, but you could imagine a whole tapestry of new events driven by factors we're not used to. But even there, I think there's nuance, and this is one of the places where people, my answer is just to get out of high carbon impact companies. But I think even that has complexity to it, because in the end, we would all love to be on renewables, but there's no short horizon on which we are, that we have a long history going forward. We're still going to need these natural resources. So do our structures reward what are likely to be the survivors if, for example, there was a major shakeup about, for example, environmental impact?
Yeah, I mean, it's a very good point, I think, and it's certainly evidenced in the work that we've done, because the scores that we produce relate to our ratings, which is a relatively short to medium term credit view, and we get a lot of inquiry from investors saying, well, that's fine for the next 3 to 5 years, but what's your view out to 2050? And coming back to what Deborah was saying about scenarios, we actually released a consultation paper last week that provides a credit view under a 2-degree scenario to 2050 using the PRI's inevitable policy response scenario that they've just put out with a few minor adjustments, but then producing a time series of views on risk for different sectors between 2025 and 2050. So trying to tackle some of that thing you're talking about, Edwin, in terms of, well, what's the forward looking? So for instance, and the point that you make about not necessarily just cutting something out is really important. So if you look at coal-fired generation, for example, in the electricity sector, what you see is that currently there's a very high risk from ESG in places like EMEA and the US, because there's been a lot of regulation that's forced the cost of carbon into credit profiles. But if you move to somewhere like China, then what you see is the exposure and the vulnerability to the risks from ESG regulation and legislation. It doesn't reach the point at which it's at in Europe and the US until about 2040. And so you can either decide that you're just not going to invest, but that's not very productive. But actually, maybe the thing to do is you invest in that transition and you try and help steer that transition. And even in developed markets, I mean, Europe, if you look in Europe, then Poland is reliant on coal and will be through to the mid-2030s at least. So again, if you can't just decide to cripple an economy and not have anything to do with that, somebody needs to support that through the transition to become a low carbon economy going forward.
Andrew, I think that's a great point about exclusion. Some of our peers have, as you may know, taken that approach, and we've decided not to because we think it's inconsistent with our mandate, which is not to serve social purposes, but rather to maximize returns without undue risk of loss. And we think that the best way of doing that and protecting the returns is to have the whole universe available to us, do the work around the long-term risks and opportunities, and leave that whole universe available to our investors in order to try to maximize returns over the long term.
Right.
Yeah, sure. Yeah.
Well, I think that's a very good the point. First of all, I mean, when I was at GPIF didn't kind of like advocated against the divestment, because the divestment basically means transferring ownership of the company we want to who we want to change to the people, the owner who don't care about the problematic business. So it doesn't make much sense. But the one thing I just want to raise here is, like, we talked about the forward looking and etc. But one of my experience how to manage the sustainability side of the the organization and fund management side of organization, or in other words, like a trading side of organization, is like one of the things which has been really missing in many asset manager, asset owner organization, is like there's no actual consensus of what they mean by their investment time frame or time horizon. So a lot of people say we are long-term investors, but if you ask the different people in your own organization, you probably get the wide range of the answers. So the ESG people, analysts, and talking about the long-term risks, and that is meant to be integrated in analysis, made by the fund managers, but they just hear it, but they don't use it because their investment cycle, at least their perceived investment cycle, is much shorter. So we noticed a lot of discrepancy, like in the same asset manager organization. The portfolio company CEO meet with the fund manager or portfolio manager as well as the sustainability officer, and they actually send different messages. And the sustainability officer sometimes engage the company on a long-term agenda like climate a day after their the fund manager sold all the holding. So I think it's very important to make at least internal consensus. What kind of the time frame. It's preferably with exact number of years. When I asked the board of PRI, what do they mean by long term? It's ranged from 3 years to 100 years. Okay, so it's not that easy to make a constructive discussion if you have that kind of discrepancy to begin with.
I think that's great.
I'll
I
be
think
a little hard nosed.
Sorry, good. Go ahead, Edwin.
I'll be even harder nosed about that as a person who's been on the buy side, the sell side, helping the government side. I think we all know people tend to do what they get paid for. And in the end, lots of people are still judged fundamentally on a quarterly basis. And that helps, that does not help make a long-term connection across these things. It's one thing to say we're going to invest on a 10-year time scale, but if those meetings with your boss are quarterly, or investors are moving money on I didn't see the returns this quarter, because a lot of these things are cases of the full information is not yet priced in the market. It's been found that climate change deniers overpay for buildings by about 7% compared to people who understand the risks. And that sort of disconnect can fully price into a market at any moment. Did it happen in the quarter? I'm pretty concerned about those time disconnects, both at a more employee agency level.
Yeah, we actually did. Can I say one thing? GPS did the survey together using a Mercer, human resource consultant. We did the survey of how the sustainability and stewardship officer remunerated inside of asset management company compared to the fund managers, and they are not remunerated on the same basis. And in many firms, the sustainability officer is still regarded as a cost center, but they need to make sure, and we have to ask a question, how they manage the incentives, as just mentioned, and also. We need to do a big change at the GPI, because the GPI always talk about long-term investment, and argue against or push against the short-termism. But the GPI used to revise the asset manager contracts on a quarterly basis, so it's not very consistent, right? So GPI, we started offering 5-year contract to the asset manager to be consistent. But those kind of a lot of inconsistency existing in our, the asset management industry practice, and we just need to solve one by one. Otherwise, we continue to face this agency problem.
That's great. Yeah, I think that, so a couple of things just to think about before we open up to questions, in terms of kind of what you would be looking for, what do you need? What is a tool that you don't have, or, what is part of the process that's missing? And I hear the kind of time horizon kind of component of it, but Deborah, over to you maybe for your comment, but also curious, as you guys are, kind of moving forward with your strategy, what are 1 or 2 things that you actually really need, whether it's data, disclosure, kind of track records, looking at that, what is something that you really need as an investor and allocator?
Just to finish up on Hiro's point, I think the time horizon and the status, for lack of a better word, and compensation that the organizations give to the head of sustainable investing, in our case, is important. And for us, I think the benefit is that part of the way we generate alpha in the public markets is taking a differentiated longer term view, right? We're not looking for quarterly or even annual performance, because that's what the rest of the market is doing. And it's hard to beat everyone else if everyone is doing the same thing. So we're really looking at, in the public markets, typically a 3 to 5 year time frame, and our turnover supports that. And by the end of 4 or 5 years, the question you have to ask yourself is, will these ESG considerations be visible enough when you look forward that it's going to impact the multiple? And I think that's a much more impactful way to ask the question than, will these climate change or other risks get priced in this quarter? but to go back to your question about data, it's at the moment, it's a very labor intensive exercise for us. And we have the benefit of, I think, culturally having an integrated approach and a very well-respected head of sustainable investment who's a former partner at Goldman Sachs, who leads our sustainable investing group that allows the fundamental investors to look bottom up at the ESG risks and opportunities. But there's a lack of data and consistency across the data that would allow us to do that on a more top-down, programmatic basis. And that creates a challenge for us as we look to manage these opportunities in areas like our passive portfolio or in our quant investing programs, where you're not doing the bottom-up fundamental analysis.
Exactly. I think, yeah, that's interesting. Andrew, I'd be curious to hear from you as well, thinking about as you guys are implementing some of this new kind of materiality analysis, if there are one or two things that would really enable you to do that as with maybe perhaps less labor intensive, as Deborah said, right? Some of that comes with just practice, because this is still 10, 15 years on, relatively new. But just curious what your thoughts are, especially as when we're talking about, you mentioned airlines and carbon emissions and greenhouse gas. I mean, thinking about water usage, thinking about, kind of different types of energy, thinking about kind of the social aspect of the ESG. Curious where you still see some need in terms of the data or the disclosure.
Yeah, and there are several areas, and given that our remit is to try and help investors by providing independent insights and opinions, there's actually a number of initiatives we have ongoing where we're trying to solve some of these. Probably the biggest single one that sits out there at the moment that would have applicability across the board would be a more simplified and standardized method of disclosure. There's quite a few sort of academic, idealistic versions around, which might work if you're a large company, but if you're a small or a medium-sized enterprise, you're gonna find something like the TCFD disclosures almost impossible to comply with. And even if you look at some of the big entities that have started doing TCFD disclosure, it's quite selective. It's still not comprehensive. But really, there needs to be tools out there that can help corporates to collect, collate, standardize, and then disclose what would consider to be essential data around some of these issues. Because even the data that's available in the markets at the moment on things like carbon emissions you were mentioning, it's not, the metrics are not standardized, and therefore the data just isn't cross-comparable. So that type of thing is very important. We are looking at a couple of initiatives on that, and we also know that there are several outfits in the market looking at trying to solve for those problems. The time frame issue, as I said, we put out the consultation paper for utilities where we're providing vulnerability scores for subsectors on a 2025, 2030, 2035, 2040 and 2050 basis, precisely to try and tackle some of those aspects that Hiro and the others mentioned. So, but if it was one thing that I had to say, it's going to be that simpler, more standardized disclosure of information, so that we can really start to build a critical mass of standardized data for analysis that can support investment decisions for investors.
That's great. Yes, and I think Edwin said earlier, it sounds simple, but it's not. Right? It sounds like something we should just have. But Edwin, I'm curious for you because one of the areas that we haven't necessarily talked about and sometimes are not included in the conversation are insurance companies, another kind of part of the industry that does assess risk, right? And so I'm just curious where you see, if you see kind of the potential for outside of kind of asset owners and managers in some of the traditional financial services world, better integration of ESG or collaboration to help kind of facilitate some of that kind of simple, concise data that both Andrew and Deborah are talking about.
I think there have been some interesting interactions, and I would separate the property and casualty from the life companies, because I think they're both in very different situations. So far, a lot of people might think, oh, a P&C company needs to care because of the storms they're insuring. And they do, but for example, they're generally offering 1-year insurance that they can then not offer the next year, which has actually greatly lessened the pressure on them. Now, I think that we can circle back to it if we get to it, but there probably will be some pressure to have longer term policies, which is going to shift that. But I think the real tension is in the life insurance world, where because they are insuring something with hopefully a long duration, our lifespans, they are long-term assets. And I think when you start buying, a 20-year muni or a 10-year commercial real estate loan made directly by the company, you start picking up timescales where these things can easily price in, and there may be drastic changes in the credit worthiness over those horizons. And I think that, in Europe, that move is kind of already in motion amongst insurers, and that has percolated through to US insurers that are subsidiaries, connections to European firms. I think that amongst US firms, the same conservatism that has generally been protective of these life insurance companies' underwriting practices during unhealthy booms like the Great Recession, where they did better, that same conservatism is maybe cutting against them here. And I think they're generally lagging in covering these risks fully at the moment.
That's very interesting. So before we take questions, because we have a few questions from the audience, I just wanted to do kind of a lightning round, and the panelists know this ahead of time, but forgive me for forcing you into a constraint. But just wanted to give kind of a concrete example, because oftentimes with these types of sessions, we talk at a high level. So I just wanted to give a concrete example and hear from each of you your thoughts based on where you sit in your various firms. And so, we did some work at the Milken Institute looking at coastal resiliency around Lower Manhattan. I happen to live in New York, so it matters to me, certainly, as does Edwin. Thinking about looking at both sea level rise and severity of storms, especially after Superstorm Sandy, where for people who are not familiar with New York City, Lower Manhattan, large parts of it are below sea level. And so the question is, if you're looking at a large global company that has its headquarters in Lower Manhattan, right across from the South Street Seaport, which is below sea level, and you're looking at, it's an infrastructure company, they own buildings, they operate real estate. If you're looking at their, Andrew, let's say, credit profile, how much do you have in terms of information, and how much do you need to really assess their risk, as you're saying, 2020, 2040, 2050, because there is uncertainty about sea level rise, there is uncertainty about storms, some of the catastrophic risk you can kind of price in. I'm curious, with that type of example, how far off do you think we are from having a really robust kind of credit analysis for that type of company?
Yeah, I mean, for real asset companies, it's perhaps slightly easier than for some others. But the reality is, in the past, people used to refer to events as being a 1 in 20-year event, a 1 in 50-year event, a 1 in 100-year event. And the linearity of occurrence has really changed over the last 10 years. And I think that starts to make this type of analysis very, very difficult. From a credit perspective, we're looking at downside protection risk. And so I think from a fixed income perspective, it's perhaps a slightly easier thing than it is from an equities perspective, because what you can do is you can look at cash flows, and therefore you would look at the propensity for those cash flows to be interrupted, disrupted, or destroyed. And essentially, when you're looking at insurable risks, and you're looking at a more frequent occurrence of nonlinear events, then you're expecting to see a greater buffer within a credit profile to be able to cope with those instances. I mean, we could get very technical and very complex about this, but essentially what you're doing is you're looking for that buffer. And you've always looked for that buffer, whether you've called it ESG or not. But now that we're looking at specific climate events, then you have to look at the tools. So if we're looking at a portfolio of assets, if it's say it's a mortgage trust structured finance transaction, then we'll be looking at the distribution of assets, we'll be looking at the loan to value ratios, and then we'll be looking at the stresses that will be applied with more extreme weather events more frequently occurring. And we'd come to a conclusion as to whether or not, you need to adjust the volatility score and the probability of default in the model for extra collateral to account for that, or whether actually there's sufficient protection in the underlying pool of assets that you're describing to see you through event risks like this occurring. But again, it's not an exact science, but it does require, back to I think it was Hiro who made the point earlier on, it requires that human input, and that analysis input rather than a data scraping model type driven aspect is really key. And that's back to Deborah's point about education. People need to understand how to interpret these events and then apply them into metrics.
So to that, Deborah, we talked about this example, and I know, kind of easy question or harder question, but simple question is, would you guys, invest? And I know that you guys have looked at infrastructure investments in areas where there might be significant climate risks. So I'm curious to hear your thoughts about how you get at some of that information that Andrew was mentioning to really understand if fundamentally overall the financial performance would survive through potential climate disasters.
Yeah. So in the example that we were talking about offline, which was an infrastructure investment in Southeast Asia, where rising sea levels and flooding is an issue, we had a case where at the screening level, so when teams are coming to get approval for the budget to do the due diligence, we identified this risk. And it does require, as Andrew said, a very human sort of bottom-up analysis of where is the asset located, how close is it to the coast, where's the alternative, in this case it was a toll road, where's the alternative road, what are the major urban locations that the toll road is connecting, and how are those going to be impacted by climate change. And in this case, there was a scenario where one of those locations would in fact move. So it had to become an integral part of the financial projections that we had. And so in your scenario, I don't know the answer because I don't know what the upside and downside is. I need some numbers to run, but the short answer is you need to run those risks through your scenarios and decide whether you're still going to get a good risk-adjusted return or not.
Edwin, I'm curious for you, you started the conversation talking about both risk and positive impact assessment. And in this example, thinking about not only the climate risk, but the social impact, right? So if we're talking about, as Deborah mentioned, possibly moving infrastructure assets because of potential climate risks, that also has a social impact. How far off do you think that we are as kind of an industry from really being able to put kind of a price on that externality, but really kind of bake into our assessment that potential kind of positive or negative social impact?
So I think it's really important to kind of come back to something that Deborah's touched on, which is what your real remit is. For a lot of entities, to consider social impact is actually complicated and well outside of what people consider their normal remit. So it really only is kind of within their charge to consider how it might then, we built that renewable power plant on Native American lands, and now we have protests that are shutting down the plant. We maybe aren't supposed to, we're supposed to take a hard-nosed view about one issue, but in the end, it creates other complications. So I think that the measurement of impact, especially because it can contradict. I mean, if we think about post-Katrina, issues of do we rebuild historically and culturally important neighborhoods in areas that we have really no belief have an environmental future if we look at sea level rise and ground subsidence? Which impact factors do we weigh? That's a very nuanced thing. And I would say broadly, we could have a much longer discussion about impact investing and the importance of knowing what actual impact you're trying to achieve. Normally, you can't do ES and G. Rarely do you get the beautiful investment that achieves in all of them, but there are trade-offs. I would say in your more concrete example, of the lower Manhattan one. I mean, clearly that's a relatively affluent area, but I would like to bring us back to maybe your data nuance point. And I think something that particular Kevin was hitting on, which is this issue of, okay, so I look at this, I do this bottom up, a commercial, a CMBS, a commercial real estate mortgage-backed security, of buildings in the area that or it's a REIT that owns buildings there. You can buy more and more better forward-looking flood data. There are a number of providers with really good science behind what they're doing. But the question of what's the defensiveness of the building? I've seen two buildings across the street where I wouldn't touch one of them with a 10-foot pole, but would buy the other any day. And then what's the actual biggest risk? You come to Kevin. Is it insurable or uninsurable? Flood is very hard to insure. What about Sandy came within an iota of completely flooding the subway system? It only flooded parts of it. Why does that matter? Well, that's really awkward, except for the fact that New York's infrastructure was pre-Sandy only hardened against flood or intrusion. If that salt water had gotten in, it would have done damage to buildings all through Manhattan that would have been incredibly expensive and uninsured for the most part. So if you don't think broadly about the risks, you just not capture everything that you need to know.
Yes, that's great. It's Andrew. Just because people always get my name wrong. Andrew, not Kevin. Yeah. But so just with the last few minutes, we has a question because we haven't necessarily talked as much about the current situation that we're in with COVID and looking at some of the social risks. So one of the question was around, obviously there's perhaps more robust data about climate and about the environmental component or the governance factor, but looking at social risks. I'm curious, for example, like Hiro, when you were looking at managers and kind of looking at their strategy, how often did they have a social risk that wasn't something other than diversity on boards, right? Because that's the kind of go-to of kind of employment and things like that. I'm just curious, so how do you think about the kind of S risk factor?
Well, S is a very challenging one. And, the GPF introduced in total 5 ESG indices before my departure. And through the first 3 years of their investment into those indices, ESG indices, we actually track the correlation between the different ESG rating agencies like MSCI, S&P, and the different group we use. And correlation of ESG scores, total, the ESG scores has been pretty much random. It had the R square of 0.1. Okay, but we also track each the alphabet separately, and over the last 3 years, there's an obvious trend, the correlation between different rating, the ESG rating agencies on the E factors has converged, and for obvious reason, we now have more and more data, right? So the difference is shrinking, but the G's has been quite effective from the day one. But didn't show the much improvement. But the most difficult one is S factors, because S factors, it seemed impossible, because when we asked all the asset managers and the rating companies, which are the S item you use for your social S rating for your portfolio company or for the subject of company, and the lists were very different from one to another. So no wonder why the correlation is not improving at all. So S area is actually, we probably need to discuss more openly which are relevant S factors. Which has the more financial materiality for the long-term investment, and that discussion we probably have to do more openly. And otherwise, we continue to have a sort of the big deviation of the S ratings.
Yeah. Other thoughts? I mean, obviously, given that we don't often think about pandemics, right? They're kind of low probability, but significant impact. Curious, Andrew, Deborah, or Edwin, your thoughts about kind of how we push forward on the S.
I think
you have to give a concrete example.
Sure, Edwin, and then Andrew. Yeah.
I'll be really quick. If you ask a question, if someone is lending very openly to economically disadvantaged communities, the question of whether that is a huge S risk or an S benefit, I've seen radically different answers for the exact same behavior because there are moral judgments in a lot of S factors that we have a lot of time trouble getting our head around.
Yeah, great point. Andrew?
Yeah, it is very much a question of definition, and you really have to get into the nitty-gritty detail when it comes to that. I mean, an awful lot of people have said, "Oh, the coronavirus is a social issue," and pretty much you can label everything as a social issue if you want to take that route. But what we would say is actually the long-term impacts are very unclear from ESG, and particularly the S aspects from coronavirus, because at the moment you're not looking at consumer behavior, you're looking at government directed activities. And it's only when that falls away that you discover whether or not the propensity to take flights for holidays and all sorts of extra stuff falls away, or whether it reverts back to the previous patterns that you've seen. So in this analysis, you've got to be really careful not to jump to rapid conclusions. There are lots of aspects that on specific areas that are important. So social license to operate, when you're having lots of entities being bailed out by the government, that undoubtedly will lead to a lot more scrutiny and analysis. And also, you've seen things like supply chains coming under much more scrutiny, not just from an economics perspective, but people starting to overlay the social aspects on those as well, because of the focus that's come about through being exposed to supply chain disruption. I'll stop there.
Exactly. Well, I know we're at time, so virtually, please join me in thanking the panelists for their time and for their insights. I think it's a great session. As Hiro said, what we try to do at the Institute is help to push forward this dialogue. So certainly we have some room to move here on the E and the G, but certainly on the S. So please stay tuned for the rest of the global conference, as well as hopefully future dialogues about pushing this forward. So thank you all very much.
Thank you.
Thank you.